Thank you very much. I appreciate each of you for joining us today. I think this is an important issue, one that frequently doesn't get the attention that it deserves. There are some things about our current monetary policy that trouble me. One of them is what I perceive to be something of a symbiotic, almost codependent relationship between Congress on the one hand and the Federal Reserve on the other hand. You have Congress spending money that it doesn't have, issuing additional Treasury instruments, debt instruments to finance that spending. And it does so really to avoid the political consequences that would be associated with either budget cuts on the one hand or tax increases on the other hand. The Federal Reserve, for its part, keeps interest rates often artificially low in ways that may mask the true costs associated with uncontrolled, out-of-control government spending. Meanwhile, in so many ways, these practices tend to impose new, additional, and hidden costs on Americans, costs that create distortions in the marketplace that are not always accounted for in standard government measures. And so you have Congress, the political institution that is supposed to be accountable to the people, in effect insulating itself from accountability, transferring some of that authority, with it the responsibility and the accountability, to another institution, the Federal Reserve, which, while consisting of very smart people, I will certainly give them that, is not representative. These are not elected people. They're not accountable to anyone who was elected, really, at the end of the day. They meet in secret. They may well have the best of intentions, the best of motives, and the best educational backgrounds, but they are not accountable to the people. This is troubling to me. It's part of what facilitates a monetary policy that I think is unsound. The time is now to move toward a sound monetary policy, and I hope that we can see that. Now, I'd like to ask, in response to Dr. Meyer's statements a moment ago, I'd like to ask Drs. Taylor and Poole to respond to Dr. Meyer's assertion that there is, in effect, a dual mandate system in essentially every central bank throughout the world. Do you agree with that?
Well, no. In fact, there's wide differences in the instructions given to central banks at this point, and some follow them more closely than others. I think what you need to look at is what central banks actually do. And in fact, during the 80s and 90s, the Federal Reserve, starting with Chairman Volcker, decided that the dual mandate, which was put in place in 1977 during the height of an interventionist period, was best interpreted as a focus on price stability, focus on getting inflation down, and not try to do a bunch of other things. And it was tremendously successful, not only getting inflation down, but getting unemployment down and getting economic growth up, and remarkably making recessions less frequent and expansions longer. So it's a tremendous improvement. Unfortunately, his interpretation, as he stated at the time, is no longer the current interpretation. Now it's completely switched, and the Federal Reserve officials now explicitly state the dual mandate as the reason for all these interventions. Because of the dual mandate, we were going to do QE1 or QE2 or Operation Twist. The Federal Reserve didn't refer to the dual mandate explicitly all those years with Volcker. So that's why I think more than ever we need to have some kind of legislation like this that makes the Federal Reserve, Congress has responsibility, of course, for the Federal Reserve. You don't want to micromanage it, but you want to give it this general idea of what its responsibilities are. And I would just say, with respect to the question on the specific impacts, I did one of the first studies on the mortgage-backed securities purchase program, and this is before the Federal Reserve actually did the studies, and found it had no significant effect, controlling for prepayment risk and other kinds of credit risk. There are studies mainly at the Federal Reserve, it's not a surprise after all, that find it has impacts. They have a different methodology. I don't think it is appropriate. I've seen that kind of methodology fail in the past. But I think most of all, there's a great deal of uncertainty about the impacts of these programs in terms of being positive. But there is not much uncertainty that they brought the Fed into this unprecedented degree of intervention, a gigantic balance sheet, which is uncertain how it's going to be resolved, and that's my main concern.
Got 7 seconds left, Dr. Poole. Can you add something? Do you want to add anything to that?
Maybe not in 7 seconds. I can't talk that fast.
I'll get to you next time around then.
Great, thank you very much. I'd like to stay focused on the issue of credit allocation. I believe in an independent